Hello, thanks for joining us today. I'm Steve Kaufman, the Senior Managing Partner of Covenant Investments, and this is Twist on Investing. Thanks for tuning in today. In the past, we've touched on subjects such as debt reduction, dollar cost averaging, why do stocks go up over time. Today, I want to touch on the difference between currency and money. Currency is a tangible object. A $10 bill is a $10 bill. Now, what it can buy, what services and goods that you can purchase with that $10 bill change over time based on a variety of factors. But a currency is something tangible that you can hold in your hand. Money, on the other hand, is intangible. It changes in value all the time. It reflects the current value of something you might own, such as a house or a car or a stock or a bond. But it's intangible. It's not something that's in your wallet. It's not something that's in your pocket. And oftentimes, currency and money are confused with each other, or we don't differentiate between the two when we look at statements or the value of an asset that we have, such as a car, a house, or a stock or a bond. But it is really important to understand the difference, and that can help manage some of the emotion we have when we look at our investment accounts or get our house appraised, or it comes time to sell our car. So I want to have a discussion today a little bit about the difference between currency and money. And remember, this channel is for those who are interested in putting the pieces of their financial puzzle in place, which is again why we covered some of the topics that we did on prior videos. And in upcoming videos, we'll talk a little bit more about planning and having a good plan in place so you're meeting your goals and objectives. But before we do that, definitely want to talk about currency versus money. So let's say we have a brokerage account and we purchase 100 shares of a stock for $10. So we put $1,000 worth of currency into a stock. The market trades, and let's say those 100 shares drop to $9 a share because of market reasons. Well, we put $1,000 of currency in there, but if we looked at our statement online or we got a statement in the mail, then it would tell us that we have $900 worth of value in the account. So our shares have dropped to a value of $900. That's the money we have in the account. We've held on to those 100 shares, but now they're worth $900. If the market changes and turns around and it goes positive, and they go up to $11 per share, with the 100 shares, we'd have $1,100. Still 100 shares. We haven't bought or sold anything, but the money in the account is worth, the shares are worth $1,100. So that's interesting because unless we sell the shares, those shares will change in value in terms of the market on a minute-by-minute basis, day by day. They'll go up and down based on economic factors and global situations. But it's important to realize that it doesn't turn into currency unless you sell it. In other words, if we look at the stock market performance over the last 80 years, the market has performed somewhere north of 8.5% to 9% per year annually. Very few of those years has it grown 8.5% or 9% precisely, but the average over time is somewhere in that range. For more information on stocks and bonds and mutual funds, I would encourage you to visit my website, www.covenantinvest.com. There's some great videos about various things, such as what's a stock or what's a bond. So check those out on my website. But if we have ownership of those things, and if you've invested properly and you have a good financial plan, hopefully you're growing the value of your money over time, because that's the whole goal of investing, is to grow your portfolio over time so that in the future you have that money to use in retirement or put a child through college, that you've turned your currency into a good investment, into more money. And when it comes time to pay for that college or to retire and generate income or pull it out to purchase something you might need while you're retired or for whatever reason you've invested, you can take that money and those investments and turn it into currency. Okay, banks are a great place to put your currency because they're designed to keep your principal safe below the FDIC limits and hold on to your currency and give it to you whenever you need it. Now, if you allow the bank to extend the maturity on your currency, i.e. you buy something like a certificate of deposit, a CD, and it's a 6-month maturity or a 1-year maturity, you've effectively turned that currency into money because you've now loaned it to the bank. You've let the bank use it for 6 months to a year. And in return, hopefully they'll pay you some interest and then give you that principal back. They'll turn it back into currency at the maturity of that CD. The goal, as we've mentioned in earlier videos, is to outpace inflation and taxes. And if you can outpace inflation and taxes, then your money will have future purchasing power. Again, something we've covered in earlier videos. You want to make sure that your money is increasing over time, that you're staying ahead of the negative effects of inflation, and hopefully also covered taxes that are due. And so your money has grown over time. And when that time comes, you liquidate those investments, whether you're selling a house that's hopefully appreciated in value, or a stock, a bond, a mutual fund, or some kind of other kind of investment. You liquidate it, and you've grown your money, and it turns into more currency that you would have had if you had just had it sitting in an account or under your bed or in a safety deposit box where it hadn't grown. So that's the idea, and that's important to understand, that when you're looking at your statements, you're checking your accounts online, that's the money value of your accounts. Hopefully, using an advisor, you have an excellent plan put in place that your money is growing. It is exceeding inflation and taxes so that you don't lose the purchasing power of your money, and it becomes a good investment for you to use down the road when you reach your goal or objective of whatever it is that you're investing for, whatever the purpose is, in retirement or college or buying a house or whatever it is. And at some point, you have access to liquidating those investments and turning them back into currency so you can spend them for whatever it is that you need to spend money on. Appreciate you tuning in today. This is Steve Kaufman of Covenant Investments, and this has been Twist on Investing.